I want to tell you something I have never said out loud before. When I was 24, I applied for my first apartment on my own. Not a student place, not a family home, my own apartment with my name on the lease. They ran my credit. And then they called me back and told me I didn't qualify. I remember sitting on the edge of my bed just staring at nothing for about 10 minutes. Not because I was devastated. I mean, I was. But mostly because I genuinely did not understand what had happened. I had never missed a payment. I had never borrowed more than I could handle. I had no idea what I had done wrong. And the embarrassing part? Nobody explained it to me. Not the landlord, not the letting agent, not anyone. I just got a no and a silence and a vague feeling that I had somehow failed at being an adult. It took me 3 more years to understand what had actually happened. And when I did understand it, when I finally saw how the system actually works, I wasn't embarrassed anymore. I was angry. And today I want to make you angry too. In the most useful way possible. If you have ever been judged by a number you don't fully understand, you are in very large company. FICO scores are used by 90% of top US lenders to make decisions about your life. 90%. And yet the average American cannot accurately explain how their score is calculated or what specific actions move it up or down. So we have a system that shapes your access to housing, cars, loans, and in some cases employment, and most of the people it affects don't fully understand the rules. That is not an accident, and today we are going to fix it. Because in the next few minutes, I am going to show you exactly who built this system, what it actually rewards, and, most importantly, the specific moves that change your score faster than almost anything else. Some of them you can start today. Let's go back to 1989. 2 engineers at a company called Fair Isaac Corporation developed a mathematical model designed to predict whether someone was likely to repay a loan. They called it the FICO score. The original intention wasn't unreasonable. Before FICO, loan decisions were made by individual bankers using their own judgment, which meant they were inconsistent, sometimes arbitrary, and, in many documented cases, openly discriminatory. A standardized score was, in theory, a fairer way to make these decisions. But here's what most people never hear. The FICO score was built by a private company for private lenders to serve the interests of private lenders. Its job is to tell a bank how likely you are to keep borrowing money and keep paying interest on it. It does not measure whether you are good with money. It does not measure whether you are responsible. It measures whether you are a profitable borrower. Those are not the same thing. And once you understand that difference, a lot of things about this system start to make sense. The score that decides if you can rent an apartment was built by engineers in California in 1989 to help banks make more money. It was not built for you. And understanding that changes how you think about every rule it runs on. So what does it actually measure? Here's the breakdown, and I promise this is the most useful 2 minutes of personal finance you will hear this week. Payment history makes up 35% of your score, whether you pay your bills on time. This is the biggest single factor. Here is what makes this brutal. 1 missed payment can drop your score by 50 to 100 points depending on where you start. 1. And it stays on your report for 7 years. Credit utilization makes up 30%. This is the ratio of how much credit you are using versus how much you have available. And this is where the system reveals its logic most clearly. Having 0 debt is not ideal. The system rewards you for using credit, just not too much of it. The sweet spot is between 1 and 10% of your available limit. So if you have a credit card with a $1,000 limit, the system rewards you for spending between $10 and $100 on it each month. Not 0, not $500, between $10 and $100, then paying it off in full. Read that again. 0 debt gives you a lower score than a small, managed debt. Who does that reward? The lender. Every time. Length of credit history is 15%. How long your accounts have been open. This is why people who have avoided debt their whole lives, who have been genuinely responsible, often start from 0 when they first apply for credit. The system has no way to recognize someone who has managed money well without using credit products. It can only see the credit trail. No trail means no score. Credit mix is 10%. Whether you have different types of accounts, Credit cards, car loans, mortgages. Complexity is rewarded. New inquiries is 10%. Every time you apply for credit, your score takes a small temporary hit. The system penalizes you for shopping around for a better deal. Think about that combination. Penalized for having no debt, penalized for closing old accounts, penalized for shopping around for better rates, rewarded for keeping multiple types of debt open simultaneously. If you designed a system to maximize lender revenue, this is exactly what it would look like. And I want to show you what this system does to real people. Because numbers on a page are one thing. What happens to people's actual lives is another. Ryan is 28. He is a licensed electrician in Ohio. He earns $62,000 a year and has never, not once, missed a bill payment in his adult life. Ryan grew up in a family that had a complicated relationship with debt. His parents had been through financial difficulty when he was young. The lesson he took from watching that was simple. Don't borrow what you don't need. So he didn't. He paid cash. He kept a budget. He sent money home to help his mom every month. At 28, he tried to rent his first solo apartment. The landlord ran his credit. He was declined. His score was 601, just below the landlord's minimum. And the reason? Not irresponsibility, not debt. A thin credit file. Almost no credit history. Because he had spent 10 years responsibly avoiding debt, and the system had no record of any of it. His decade of discipline was invisible to the score. His absence from debt looked, to the algorithm, like a risk. Ryan is not rare. He is millions of people who did what they were told, avoid debt, live within your means, and then discovered that the system they never engaged with was quietly building a case against them. Okay, here is where we stop being angry and start being useful. Because understanding how the system works is only valuable if you know how to move within it. Move 1. Become an authorized user on a trusted person's account. If someone in your life, a parent, a sibling, a close friend, has a credit card with a long history and a solid payment record, ask them to add you as an authorized user. You don't need to use the card. You don't even need to have access to it. Their history on that account transfers to your credit file. This is the fastest, legitimate way to build credit history from nothing. Ryan's sister added him as an authorized user on her 8-year-old credit card. Within 60 days, his score moved from 601 to 662. He got the apartment. Move 2. Get a secured credit card and use it exactly right. A secured card requires an upfront deposit, typically $200 to $500, which becomes your credit limit. Use it for one recurring bill each month. Your phone, a streaming service. Set up autopay to clear the full balance every month. Never carry a balance. After 6 to 12 months of this pattern, you have a real, consistent payment history on your report. Move 3. Fix your utilization before your statement date. If you carry any balance on a credit card, even a small one, pay it down before your statement closing date. Not the payment due date, the closing date, which is when your card reports your balance to the credit bureaus. Keeping your balance below 10% of your limit before that date can move your score by 20 to 50 points within a single billing cycle. Move 4. Pull your credit report and look for errors. 1 in 5 Americans has at least one error on their credit report that is negatively affecting their score. You are entitled by law to a free report from all 3 bureaus, Equifax, Experian, TransUnion, every year at annualcreditreport.com. Pull it. Read every line. Look for accounts you don't recognize, payments marked late that weren't, or balances that don't match your records. Dispute anything wrong directly with the bureau. Ryan pulled his report as part of understanding his score. He found a medical bill from 2021, $180, that had been sent to collections without his knowledge. He disputed it. It was removed. His score jumped another 34 points in 45 days. Ryan went from 601 and rejected to 696 and approved in under 4 months. No new income, no credit card debt. Just 4 moves and the knowledge of how the system actually works. Start today. Go to annualcreditreport.com right now. It is free. No card required. Pull your report from all 3 bureaus. Read it. Write down anything that looks wrong. That is it. That is the whole action. Ryan's turnaround started with exactly this step. 10 minutes, a website, and paying attention to something most people never look at. You are not bad with money because your credit score is low. You may simply be someone who has not yet learned the specific rules of a specific system, a system that was built by someone else, for someone else's benefit, and never came with a user manual. Now you have the manual. Ryan has the apartment. You have the knowledge. The rest is just moves. Next video, we are going shopping. In 1995, I want to show you exactly what your money used to buy and what happened to it. Because the story of inflation is not what most people think it is, and the real version of that story changes what you do with every dollar you earn from here. Quick note before you go, everything in this video is for educational purposes only and is not financial advice. All statistics come from verified public sources, including FICO Score Credit Insights Report, September 2025, Experian Credit Score Data 2025, Federal Trade Commission, AnnualCreditReport.com, Consumer Financial Protection Bureau. For advice specific to your own situation, please speak to a qualified financial advisor.